Okay, great, fantastic. Good afternoon, everyone. My name is Jeff Hu. I'm a board member with the LBHOA, Lenape Bay Homeowners Association. We are a 100% volunteer group serving our local community, and having our webinars is one of the many activities that we provide, including some summer concerts and some other Harvest Festival and Christmas festivals, as well as helping out our local community with Beautify Lenape Bay and many other activities. So today, I'm really pleased today to have Dividend Growth Partners presenting for us. They have been, I believe this is our third year, Terry, of presenting and just sharing with us. So I've been really informative and grateful that we have the resources to have such high professional level of sharing and information and ability to ask questions directly to our community. So really appreciate it. Wanted to just, have Terry and Valerie introduce themselves and a little bit about what they do, and then we can get started. But before we do that, I just want to, one or two more housekeepings, is that today's format is going to be more of a roundtable. We have fielded a lot of questions from our email, and the participants have sent them in. If you would like to ask any questions, please do post them up in the chat. I'll be looking out periodically, and we will be answering, and Terry will be guiding us through those questions. And then lastly is this meeting, this webinar is recorded, and for all the people who participated, we'll be sending the link so you can watch it and share it with other people as well. So without further ado, Terry, would you like to start and introduce yourself and DGP?
Sure. Thank you, Jeff. You can hear me okay?
Perfect.
Perfect. Okay. So yes, thank you. Thank you for inviting us. And I'll just say a quick word and then ask Val to introduce herself as well. But at Dividend Growth Partners, we're a registered investment advisor. We work with a lot of small businesses, families, corporate plans, and so on. So we have a variety of clients, and we serve both the local community, and then we have actually a number of clients, different areas all over the nation. And we're just completely independent. So we aren't connected with any particular, large investment fund or anything like that. And we really enjoy just working in the markets and working a lot with families and individuals and businesses that have questions. And of course, given all the activity that's happened recently, we've been getting a lot. So Jeff, I was glad you gave me a call. I think it was about a week or 2 weeks ago, just suggesting that, this might be a good time. And we've been getting a lot of questions from clients. So it's a good opportunity for that. Just a little bit about myself. I've been in the investment business for many years. I used to manage large mutual funds with Capital Group, and have done this independently. We're part of a group called Ridgewood Investments, and we started working with Ridgewood in about 2012. And then Valerie, also we worked together at Capital, and then she came over to join here. So I'll let her introduce herself, and then we'll get right into the Q&A session.
Yes. Hi, I'm Valerie Lemon. So as Terry mentioned, we've worked together for a long time. I was at Capital with him, and now been with DGP for over 12 years now. So I've been in investment management for that long. I do a lot of investment analyst work, so helping Terry with research on different companies and areas of the market and funds, things like that. So it's nice to see so many people here. Hopefully we can get some questions answered.
Perfect. Thanks so much. So Terry, just to kick it off, would we like to address the first question? I think you had something that you wanted to share with everyone before we get started.
Sure. So, So Jeff, when you called up and you were asking, about general questions and doing this, it was very well timed because we've been getting a lot of questions and having these discussions. And so what we did is, as part of this, we reached out to our client base and have them send in their questions, which I've passed on to you, some of those. So we'll get to those on the call. And of course, as you said, anyone who wants to do something real time, feel free to do it in the chat session. And then also, if there's something I say that's unclear or you'd like further explanation, please do bring that out, and I'll be happy to go back to it. So before we get to the questions that I passed on to Jeff, there is one kind of large area that I wanted to address. And so I have to say, in working this business and working with our clients, we really do have just incredible clients in the sense that we spend a lot of time focused on longer term investing issues, kind of strategic planning and so on. And then most of the questions that come up over the years are either very specific to their own financial situation. Should I withdraw Social Security early or wait till the end? Or do I want to be more in bonds or fixed, things like that. And then there's more tactical questions depending on what's going on in the markets and so on. But I have to say, in the last 6 months, not surprisingly, there has been a flood of questions around what's going on in the government. And we have a very diverse client base. And so it's great for us to see, because we get the questions from all sides of the political spectrum. And it can be pretty interesting, right? Going into the election, literally the week before, I had a discussion with one person who was very concerned that the election might go for Harris, and so they didn't want to do anything. And then literally like an hour later, had the same exact discussion on exactly the other side. Someone was concerned that Trump was going to win, and they didn't want to do anything. And so there's a lot of that. And then what's been interesting, of course, is now that we had the election and we're into the first few weeks of the new administration, there's been a flurry of activity. And this kind of has, regardless of what political side you may be on or your views, it has created a lot of questions, and people don't, there's a lot of change going on and things are moving at a very fast pace. So there's a lot of, I would say in some cases, anxiety. Other cases, again, if you, let's say the election didn't go your way in the fall, you might have, there's a number of people have real concerns that this could, they're seeing what's going on and they're very worried about what it means for a lot of things, not only how they feel politically, but also economically and their investments. And, you hear all these news about tariffs and so on. And then you get the other side of the spectrum where people feel like, they're seeing what's going on and they're feeling good about it. And they're feeling like this is a time for a change, and they're optimistic and they're kind of very bullish on things. And so you get a real mix. And I think the main message that I would try and convey from the investment side, and sounds kind of harsh to say, but I think it is something that we all have to grasp is that at the end of the day, the market doesn't care what your political views are. And I know that sounds harsh, but it's really important to understand that the market really is not interested in how you feel politically. Now, I'll get back to how you can convey, if you feel strongly one way or another, how you can convey that. But it's important to be objective about it when it comes to investing, because I think if you take a deep breath and separate as best you can political views from what's going on in the markets, it can really give you some grounding and make you more objective about your investing. And, as a professional investor, I have to deal with this every day because I've been investing since the 1980s. I love looking at the markets. I work incredibly hard. I put in a ton of time. I went to the right schools to learn all the things I've learned from, some of the greatest investors in the world. I worked at a large mutual fund managed, all the things. And I put in a ton of work. And you know what? At the end of the day, the market doesn't care. It's something I have to deal with every day because I can have some incredibly well thought out, well researched idea based on my experience as an investor. And you know what? At the end of the day, it's either going to work or it's not objectively. It's not because of where I come from or what I've done. And it's sometimes really hard for professional investors to understand that. We saw that probably the most egregious example, I think, was with GameStop, where you had a lot of professional investors who were short this company that was basically headed to a long road to zero. And intellectually, they had it all right. But what they didn't understand was that sometimes you can have it well thought out. And for a variety of reasons, the market can go the other way. And in this case, they ran up against a force that in many cases caused them huge financial pain when they were on the wrong side of that thing. So it's an important lesson. It's a lesson I have to think about every day. But I would encourage all of us, when we think about our own investments, that not to mistake strong political views either way. If you're excited about what's going on in DC or you're nervous about it, to translate that into assuming that it's obvious one way or the other, and that it's going to translate into investments. And so an example of that would be, and we'll come back to it later, but we've seen a lot of concern around tariffs. Okay, so there's a lot of discussions, tariffs, we're going to have tariffs on Mexico, tariffs on Canada, tariffs on China. There was even discussion, a temporary thing about Colombia and so on. And it's just head spinning and people don't know and it doesn't sound good and so on. But you have to look at how the market's reacting, right? That tells you something. The market is at least indicating that, well, you know what, we don't know where this is all going to go, but it's not looking extreme one way or the other. Now, that can always change. I'm not saying that things won't go one way or the other, but if you're worried about all the news flow and so on, you can look at the market with some reassurance and realize that if something was really awful out there, that usually the market responds, and it responds very quickly. And it responds quicker than most of us can even react. The other thing that's very important about that is that the market can also be self-correcting. And we'll come back to this a little later, but if the market if something goes too far, so let's just say, right now, if you look at tariffs, there's been a lot of talk, but ask yourself, what has actually happened, right? Are there tariffs with Canada? No. Are there tariffs with Mexico? No. Are there tariffs with Colombia? No. Now, they've all been talked about. And with Canada and Mexico, there's been a 30-day interim period, but they haven't gone into effect yet. And even if and when they do, there's already things that are going on. They're talking about, well, if you put a plant in the United States, then, maybe that's not going to be included. And there's things, and it becomes a negotiating tactic. Where we do have tariffs is China. So the China tariffs went into effect 10%. So what's happened there? Well, turns out the Chinese stock market is doing just fine. It's actually up 4x the S&P this year. That's a whole nother thing that we can get to. I'm not saying that things will change, but I think, again, the markets are reacting differently than any one of us might feel just using our political views. The last thing I would just say on that is, again, if things get too extreme, so let's say there's some policy that goes into effect and the market reacts very negatively. It's not just a static situation. And we do see this a lot where the market will react and then government will often respond very quickly. And so let's just take an extreme case that some tariff is imposed or some group within the government is cut, and all of a sudden something, the market reacts very negatively. Chances are, at least history would suggest, that that's not the end of the story, that in fact, the politicians on every side of the aisle are responsive to that. And the greatest example of that was during the financial crisis. So for those of us who can remember back in 2008, the whole Great Recession, you may remember that the government came with a bailout bill to Congress, and Congress didn't pass it. And the market immediately reacted. The market sold off instantly, and it was a huge thing. And boom, right back. They just came right back and said, okay, if we're going to pass it. And that kind of thing happens a lot. So obviously there's a lot going on, and no one knows what the future has. But I just say, take a deep breath and try and separate as best you can the political views, either pro or negative, versus the reality of investing in the market. And again, we can come back to more, but I just wanted to address that up front because I have seen that in a lot of questions that we've received so far. So let me stop there, Jeff, and we can go on to the other questions or follow-ups on that.
Okay, great. Yeah, thank you, Terry, for starting us off with that. Just to follow up with your tariff example, I'm glad that you feel very comfortable that the government will always help out, and we just have to take measured responses. But let's say that the tariff has some impacts. Do you think that the question is, will it cause any inflationary pressure? So from your experience, of course, we don't know what's going to happen in the future, but in what case or what case not would we have any inflationary pressure? And do you foresee any of that happening?
Absolutely. I think it's a total risk. If you just, I studied economics in school, and you study tariffs, and the reality is that if you impose tariffs and on top of that, you move towards more insourcing of things like manufacturing or, producing things domestically versus open and free trade, you're absolutely going to get higher prices and so on. And I think I would also couple that with, the administration. They say a lot. Trump says a lot of things, so you can't always take it at his word. Sometimes I think he does it very much for negotiation and so on. So it's not a criticism; it's just, I think, just an observation. But he's also tried to make it clear that yes, he calls it short-term. There's going to be short-term pain. Now, whether or not we'll see it is another thing, because I don't know the full extent of the tariffs. But let's say that some tariffs will go through, and we've already seen a little bit with China, and I expect to see more. Then yes, that will cause inflation. I think the other thing that often doesn't get discussed enough is that it gives people cover to raise prices. And so when you hear in the news tariffs and inflation and so on, when you go to the restaurant and they tack on a $3 surcharge because of something and they blame it on tariffs, what are you going to do? It's like, okay, I guess, yeah, that sounds about right. And so I think there's a lot of that too. Now, whether or not that's actually from the tariffs or just they're trying to cover their costs, but you see that a lot. So yes, I would expect more inflation.
Okay, fantastic. And then a follow-up on that, if there is more inflation in the future and let's say more tariff impact, do you think that there's going to be any further cuts in the Fed rate, or do you think, are there any risk of increase? So I think those tie together, right? If there's high inflation, usually that means that they're going to push down the interest rate. So what is your view on the future cuts, or do you think they'll increase?
Yeah, no, that's a great question. So as many people probably know, the Fed has two stated mandates. So one is around price stability. And basically it means kind of keeping inflation in check. And they have this 2% target that they often talk about. You can go down a whole rabbit hole of why it's 2%. But anyway, the idea is just to keep inflation in check. And then the second one is to monitor and maintain more stable employment, so unemployment doesn't go too high. And so as most people know, we were in a period of very low rates, largely around COVID and what happened there, and then just trying to help the economy and so on. And then we went through a period where they started raising rates over the last 2 years, and now we've kind of leveled off. And so the question is, well, what happens next? I don't have a good crystal ball. I do think that in addition to the two stated things, which at the moment seem to be okay. Unemployment seems to be okay, and inflation okay. They are very data dependent. They've stated as much. And so I think if we see unemployment rates start to go higher or inflation go higher, they will react, or go lower. I mean, it can go either way. They'll react. The challenge is with just those two levers to look at, it can put them in kind of a tough spot, because if unemployment goes up, you want to lower interest rates to kind of stimulate the economy. But if inflation goes up, you need to raise interest rates to kind of put on the brakes. So you can get into one of these situations where unemployment goes up and inflation goes up, what's called stagflation. Those who lived through the 70s and saw that, you know what I'm talking about. So that can be a difficult one. But, there's another part too, which is the unstated goals of the Fed, they're really the backstop for the economy. They're a backstop for the market. They don't really like to talk about this, but I mean, the reality is if the market tanks, it wouldn't surprise me if the Fed jumped in and started lowering rates. They're supposed to be independent, but they are under political and social pressure to do certain things. And I think the other one is that, we have obviously a huge deficit and debt for our government, and that all needs to be refinanced. And what the Fed is doing is critical to the rates at which the refinancing takes place. So they have a lot of competing things. And the final thing I would just add is they need to keep some dry powder available, meaning that as much as they would like to probably lower rates to help stimulate the economy, they also need to make sure they don't go too low, because if we get into a crisis, they need to have something to go to. So I don't think there's going to be a lot of activity here. And I think the biggest implication that I wonder about is in the housing market, because the housing market's been really stuck for about 2 years now. And everyone keeps saying, just wait, rates are going to go down, the mortgage rates are going to go down and so on, and they're not. Mm-hmm. And so something's got to give. And I think if things stay where they are, something interesting is going to happen in real estate, because either housing prices are going to have to drop, or buyers are going to have to come in, or something's going to have to happen, because it's just this kind of, we're at super low rates of houses being bought and sold. And as much as in the old days, it used to be America was really dependent on what happened in the auto industry, because it had all these like secondary effects. Today, it's really real estate. I mean, what goes on in the housing market has all sorts of implications for, renovations, construction, design, furniture. I mean, it just goes on and on and on. And so we've been in kind of this holding period, but if things stay where they are, it's going to be very interesting to see what happens in real estate.
Okay, thank you for that. Keeping the question more at the macro level, we can go micro. There's some questions on the micro level, but at the macro level, someone stated that, they think that the markets are pretty high, pretty frothy, and unlikely to go up anytime soon. That might be true or not true. But given that, what would be some strategies to reduce risks in investments? And is this the time to be more conservative? So I think I asked you the same question last week. That's when I called you about this. And, I was thinking, hey, should I move more into cash? And, all these questions. So I agree with those kind of sentiments that it seems pretty high. It's not going to, the upside is low. The downside seems pretty high. So in that case, one, do you agree? And second, what can we do to reduce those risks?
Great question. There's a lot in there. And Val, too, if you have anything, please feel free to chime in on any of these. But so first thing, let's go back to the question itself. So the market is high. Yes and no. That's a typical economist answer. On one hand, on the other hand, but it depends what you mean by the market. if you're looking at large and mega cap growth stocks, they've had a terrific run and many sell at very high valuations. So that, yes, is true. And on top of that, because of the large influence of those on the S&P 500 index, you may have heard of the Mag 7, kind of the leading 7 tech stocks that are the major influence on the S&P 500 over the last 2 years. So last year, to give an example, if you took those out, the return was half of what it was just from those 7 stocks. And that is true. So you do have an area which has done really well and is selling. If you look at any sort of historical measure of growth, large cap growth stocks, we're very much at historical highs. That being said, that is not necessarily the market. And the market is made up of a whole bunch of things. And if you look at stocks outside of those, if you look at deep value stocks, you look at small cap stocks, you look at stocks outside of the US, you find all sorts of interesting companies at reasonable valuation. So I think it really depends on what the market is. That's number one. The second thing is, even if you are just dealing with the S&P or you're dealing with large cap growth stocks, just because they're at high valuations and have done well doesn't mean they can't go higher from here. Mm-hmm. And it can be both on fundamentals. We've seen some incredible growth out of very big, large companies. You look at, Meta, you look at Google or Alphabet, they've really put up some very good numbers. NVIDIA, of course, the numbers, the stock has done great. The multiple is high, but the earnings have been very high too. It's really been an incredible story. On the other hand, you also have companies and indexes that can continue on well beyond the fundamentals. And so just because they've done well doesn't mean they can't further. And a good example is you look at Apple, which is, of course, the largest market cap. So it's the biggest company in the S&P. It hasn't grown in 2 years. Their earnings have gone nowhere. Their revenue's gone nowhere. They really haven't done anything. Apple Intelligence, I don't know if anyone on this call loves Apple Intelligence, please chime in. It doesn't mean they won't get it right, but let's be realistic about it. Apple's done nothing for 2 years. It's flat. Their largest shareholder sold $100 billion last year of stock. And interestingly, Apple bought $100 billion of stock last year. Now, what's happened with Apple? It's gone up 60% in the last 2 years. So, you could say it was overvalued 2 years ago, and on the fundamentals, you probably would have been right. And yet here it is, 60% higher. And so it went from a mid-20s multiple to now mid to high 30s multiple. And even then, it doesn't mean that, Apple's a bad idea. Maybe it could do well from here. So I think that's to say, I wouldn't just assume that the market is, exhausted. But I do, and those who know, what I focus on is, I would say of the indexes, probably the S&P is not the most interesting right now. I think there's a lot of great opportunity elsewhere. Certainly year to date, I know it's young, but you've still seen that. I've been talking about what's going on in China for 2 years now. And China is really doing well. It's up 4x the S&P this year. Europe, which everyone seems to beat on all the time, is 2x the S&P so far this year. And in both cases, the valuations are much lower. Now, all that being said, there's nothing wrong with being conservative. And I think investing is a very individual thing. And that's why I encourage people to look at your own situation and your own comfort level, rather than worrying so much about benchmarks and FOMA, fear of missing out on something and what's going on with someone else's portfolio. The key is you're comfortable in your own portfolio. So if someone wants to be conservative and they feel this is a time to do it, there's absolutely nothing wrong with that. I think certainly bonds for the first time in, the last year or so has finally offered some opportunity where you can legitimately sock away 4 or 5% very conservatively, tuck that away. You can just stick cash in a money market and earn 4% and wait until a better opportunity. The one thing I wouldn't recommend doing, though, is trying to time the market. I know everyone says that, but if your idea is that you're going to wait and be conservative until things clear up, it doesn't work that way. By the time things are clear, the market's already moved. By the time things are less certain, the market is already up. And so this idea that, I just don't like what's going on in Washington, or I think the market is toppy, be careful, because if you're going to take money out of the market and then try and put it back in at a later time, you really have to ask yourself, are you going to do that? Because the best time to do it is when things are awful. And so let's say you put money aside now because you're nervous. Let's say some tariffs hit and the market sells off and you're congratulating yourself because you were conservative. Are you then going to step in and put money in when things are looking really bad? If so, that's great. But I can tell you from experience, it's really hard for people to do. So anyway, that's my thought on that. Val, I don't know if you had other thoughts on that or anything I missed. But.
No, I mean, just to echo that, often the way back in is too fast for you to have, gotten there before some kind of, rebound happens. The other thing I wanted to mention that Terry had touched on, while the market doesn't care about your political views, it does care about having, when there's ambiguity. And so when there is a lot of stuff happening, just keeping in mind that sometimes there will be short-term things, that will affect the market that sometimes you just have to chalk up to the market not understanding, not having clarity yet. And a lot of those things are, short-term in nature, and sometimes you just have to hold and wait and see. And particularly if, just as Terry mentioned, just the observation that there is a lot of activity going on. And so just to have some patience around that.
Okay, great. Just to follow up on that, I think Terry had answered this question, and then maybe Valerie, there's the next question you can chime in. But there's someone who had said, should they just leave it in the S&P 500 and let it ride, opposed to diversifying? Some years maybe you would take a hit, sometimes you don't. But it seemed like what you just had said is this is probably not the best time to do that, and maybe it is good to diversify. So I would just want to clarify if I heard right, Terry, what you said about that, because this person had asked a very specific question. Should I just dump it into the S&P 500 and let it sit there, or should I put it into different areas?
Yeah, so it is a slightly different question than I was trying to address, which was, is the market, the market seems high, right? Should I be more conservative? So I think this is like a longer term question, why mess around? Why not just put it in the passive S&P index? And I think it's a great question. And first thing, I should be clear. I do active management. So, you have to take that for what it is. I have a biased view, of course. But that being said, we actually do indexing in part of what we do when it has a time and a place. We do that. So we do a mix. And I certainly don't see anything wrong with putting some of the portfolio into an index. So if you want to have exposure to something like the S&P or NASDAQ or some other index, and that's part of the investment plan, that makes all the sense in the world to me. I think the problem that I see in investing a lot is sometimes when people go to extremes and you go all in on just one strategy. So it makes perfect sense to think about that, where you say, well, the S&P, it's real easy. I don't have to think about it. It's done great. It goes through some bad years, but over time it's done really well. And that's fine, but there's actually much more to the story. So the first thing is, if you're going to go all passive, then the first question you have to ask is, well, do I want to do all stocks, or am I thinking about all investments, like, or at least everything in the market. So typically when you do that, all of a sudden bonds come into the picture. And so you might hear of like a 60-40 portfolio, or depending if you want to be more aggressive, less aggressive, but that would be 60% stocks, 40% bonds. So if you were truly doing that, you would say, okay, I'll do passive indexing. I'll do 60% in the S&P and 40% in the aggregate bond index and call it a day. And I'll rebalance every year. Sounds great. Well, the S&P's done really well. The bond market has been awful. And if you bought the bond market, the aggregate bond market 5 years ago, you're underwater today. So you've lost money in that market. And, anything can happen. And with hindsight, it's easy to say, oh, well, okay, I should have been in the S&P but it's not, with bonds, it was actually very foreseeable when you're looking at aggregate bonds just passively. And for those who heard me going on about bonds years ago, it was just, if long-term bonds are offering you 1 or 2%, it's really a no-win situation. And that's what happened to so many people who went into the passive index. And if you just ask anyone who's had a target date fund, the results have been really tough. And it's one thing to have tough results, but it's another thing if it's not for the right reason. And if it's because it was just, well, I put it in, then, that's a tough one. The second thing is you want to make sure that if you do commit to an all-in strategy of a passive thing, that you understand what you're getting into. So the S&P is a fine index, and there's actually a lot of good reasons to theoretically think about why it does as well as it does. But you have to understand what you're missing too. You're getting exposure to essentially very large and mega cap stocks. And now we're at a time where it's incredibly concentrated. So you have a lot of companies that correlate together. So you look at the Mag 7, they tend to, for the most part, move as a group. There are some exceptions, but you're getting a lot of very high correlation. What are you missing out on? Well, the S&P doesn't have non-US stocks. So right there, it's kind of the whole rest of the world. What about small cap? What about mid cap stocks? What about, in this case, it's very much now a growth index. What about value stocks? So you're missing out on a lot, and it takes you away from being diversified. And I think the real kind of critical question I would ask with any investment is, for whatever reason you do it, if you want to ask yourself, if things don't turn out as I expected, if I look back 5 or 10 years from now and I'm on the wrong side of the results, in hindsight, did I do it for the right reasons? And I think when you go all passive, as long as you're comfortable with that, saying, yeah, I just went all passive, I didn't care about the valuation, I wasn't diversified, and I went with this. And if things go back to a different scenario where all of a sudden international stocks start outperforming, small caps start outperforming, and you're missing out on that and you're comfortable with that, then I think it's okay. So other than that, I would just encourage it as part of an investment plan, but not an entire investment plan, at least from my experience. But again, every individual is, it's your own investments, and you want to do what you're most comfortable.
Great. Thank you. We have probably about 15-20 minutes left, so I want to switch gears to 2 areas that I'm very interested in, and I think a lot of people as well, based on the questions. So one is AI, and the other one is crypto, right? So why don't we tackle the AI one, because I think that is a little bit newer. And a little bit more in the forefront, so we can spend a little bit more time on it. But it seems, fairly clear that there is a lot of acceptance, a lot of tools coming up in the AI that are very useful and being integrated, and a lot of, the DeepSeek kind of phenomenon is bringing a lot of attention to the kind of like the war in AI of who's going to be dominating. So I believe, like this gentleman or participant said, it's like the internet 30 years ago, right? So we went from writing letters to email, and now we're going from email to the AI agents and et cetera. So should we be considering AI sector funds or something similar focused in AI?
Yeah, a great and very timely question. Obviously, a lot of people are wondering about AI, a lot of focus on that. So this is something where my views have changed over the years, where when there's a new area that's emerging, and even when there's a lot of uncertainty, and this would apply to crypto as well. I used to say, this is probably 10 years ago and past, I used to be very cautious. I used to, because there's a lot of things that look great until they don't, and then you get burned. And I think over the years, I've actually come to a very different perspective, which is if there's an exciting area that you want to learn about and looks good and promising, and certainly AI has all the promise of being maybe the next greatest big thing, then absolutely, if you want to put a small portion of your, portfolio towards it, then great. Just don't go overboard, and it's a good way to learn. And just be careful because, particularly with a new and exciting area, it's easy to see wild swings. And I wouldn't put in money that you need, tomorrow or the next day or a year from now. But there's something that you can put aside a little bit. Yeah, I don't see any issue with that. And just make sure you can afford to lose it. And it could turn out to be fantastic, and you can learn a lot in the process. So that's one approach. The other thing I would say is that if AI turns out to be as promising as it looks like it could be, just like the internet, remember that the early winners or the early stars aren't necessarily the ones that end up being the best companies down the road. And even the ones that do turn out to be the winners, you often have many, many times where you can buy them, where they sell off significantly, or there's a concern in the area, and you can go in and buy it. The other thing you can do is look at companies that aren't dependent on any one winner. I do this a lot in technology. If you look down the food chain to companies like the contract manufacturers, or you look at the semi-cap equipment companies, they kind of win no matter who ultimately wins. It doesn't matter if it's, Alphabet gets it right, or Apple gets it right, or some other company, or NVIDIA is the ultimate winner, or maybe, I don't know, Intel comes back. At the end of the day, they all kind of have to use the same equipment. And so there's opportunities there as well. So that's another way to do it. But yeah, for certainly getting some exposure in an area. The other thing I would just say, I came across this a few weeks ago. I was reading this advice, some financial advice column, and someone said, and this is kind of a typical situation you run into, but it was like a grandparent saying, my grandchild is really interested in crypto and wanted me to invest a few $100s in Bitcoin or something like that. And I don't know if I should. And the advice was like, well, if you're concerned about it, don't do it, all this kind of stuff. And I get it. And certainly if you can't afford to lose the money, that's fine. But on the other hand, maybe, just maybe, as a grandparent, you might learn something by, if it's not money you're going to miss, you do few $100s with your grandkid, and at the very least, you have something to spend time with your grandkid about, and you learn a lot together. And so, you can even do it and say, hey, I have reservations about this, but I want to learn. I want to learn about this cryptocurrency, and let's try it. And at the end of the day, if we end up losing a little bit, it's okay, and we've done something. So I would really encourage that for a lot of things like this.
Okay, great. Valerie, did you have anything to add on the AI bandwagon and the research you guys have been doing on that side?
No, but I do echo what Terry said. I'm all for putting a little bit into all these new technologies. And, as he mentioned, we often look for other ways to play it that maybe they don't see the same the same heights, but they benefit in most cases. And so that's, that we often see opportunities like that.
Okay, fantastic. So I think this, Terry touched on it, and the kind of next step is, if you do believe that there is a future for AI and the development and the downstream, as you had mentioned, has to be a huge change in infrastructure for the power and energy to run these platforms, and creating these rails and learning all these new kind of definitions of how this infrastructure and AI is going to play out. It also blends into crypto, because we can't use the existing SWIFT system. We can't use the existing banking and financial systems to go and service the AI that can do billions of trades 24 hours a day, right? So that's why I'm very interested in crypto, because cryptocurrency is kind of like the currency for AI. That's what a lot of people are saying. So I guess the next one or two questions with crypto is, do you think there's going to be a Bitcoin strategic reserve? And do you think that people should invest in crypto or cryptocurrencies? And do you have a specific percentage holding you would suggest? So on that, adding some of the political flavor to it, is that Trump administration, to me, seems like a very pro cryptocurrency and, like more free market. So, taking those in consideration, do you think there will be a reserve? Do you think that would be healthy to have part of reserve? Because then that means every other country in the world has to get some Bitcoin or these currencies.
Yeah, I mean, as you know, views in the crypto market can be very strong, just like political views. And I certainly have a few. I can say generally, with respect to the strategic reserve, and anything is possible. You hear the administration talking about it. My personal guess is that, like many things that you hear out of the current administration, there's probably a way that we may see it unfold that's not a full outright, that kind of pacifies everyone. And so instead of like, okay, we're going to do just like we have we have gold in reserve that the government keeps, all of a sudden we're going to have the equivalent in crypto, or like we have the strategic oil reserve. That could happen. Anything could happen, but I could see something short of that could actually achieve the same objectives. And the most likely one is whenever cryptocurrency gets confiscated, it wouldn't surprise me if there's some, the traditional approach for the government was, if we come into cryptocurrency, we immediately try and get rid of it and turn it into dollars. It wouldn't surprise me if someone sets up a program that changes that, so someone's actually managing a portfolio, and then it achieves both objectives, because you can, for those who want a strategic reserve, say, yeah, we actually have the crypto and we're managing it, and so it kind of meets that. But you don't have to put an outlay of huge amount of funds. I think there's some political risk if they were to set aside a large amount, particularly with if you just look at Bitcoin, it's done very well. And if it were to go the other way, it might not look good, just from a timing perspective. So there's some other issues there. I do think long-term that there's a lot of opportunity here. I kind of agree with your thing about the rails. And to me, there's actually the most interesting question, I think, in crypto that you don't hear as much about is that even for the skeptics, you have to admit the institutions have come around. So it's here to stay. And so there's now crypto funds, there's everything from endowments to corporations that are looking at there's MicroStrategy, which is in a whole nother league as everyone else, but there's a lot of very more conservative companies that are saying, hey, why don't we allocate some portion to this as a reserve? And then if you follow that logic through, institutions want to be diversified. So right now everyone focuses on Bitcoin, but if you kind of go down that ladder, it means well, okay, it's not just Bitcoin, it's going to be Ethereum, it's going to be some of the premium alts like Solana and a few others. They're not going to get into the crazy coins that are out there. But what it means is potentially a lot more than Bitcoin. And what to me is so interesting about that is for other reasons. But, while Bitcoin's done great, Ethereum is not. I mean, I don't know how much people here follow what's going on in the crypto market, but Ethereum's done nothing for a year. And Bitcoin's up about 65%. So that ratio of Bitcoin to Ethereum, and there's reasons for that. I don't need to, it's not really a call about that. But I think it is quite logical for the institutional market to look at something other than just having a Bitcoin reserve and more like a crypto reserve or even an alternative asset reserve. And so you expand it beyond just cryptocurrency and you include other things that are other than traditional financial assets.
Okay, yeah, I think there's a lot of use cases, and those areas to me are very interesting, let's say for financial services or for contracts, etc., and using some of those other altcoins as a currency for those specific verticals. But that's a completely different game.
Right. No question. And Jeff, sorry to interrupt, but you're absolutely right. I mean, you've already seen that in the acceptance of stable coins, which, as many people may know, are basically just their equivalent of, they don't change in value, but they're basically a way to do, Jeff, exactly what you're saying. And that's, I mean, the acceptance of those has really taken off, just like you said. So.
And they're in the multiple billions of dollars. They're not like million, they're billions. So it's pretty interesting what's going on there. So thank you so much for touching base on those two. We have just like a few more minutes. So I wanted to go back to one or two questions that had just popped up and a little bit more traditional questions. But, with a lot of changes happening, do you have any insight to what might impact people who are more in retirement in terms of their pension or Social Security? I think that's a question people are interested in, and it kind of falls into the same area of someone who said, do you think there's going to be a recession later this year or 2026? Of course, there's going to be a recession one day. Who can tell when? But do you have any comment on what's going to happen to people's pensions, Social Security, and if there's going to be a recession anytime soon?
Okay, so I actually see those as kind of separate issues, but because I think the issue on the pension and Social Security is people are there is some concern that those benefits may be at risk, regardless of what's going on in the economy. All this talk about Doge and cutting back and so on. Again, anything is possible, but if I were receiving right now Social Security or some sort of pension, I wouldn't lose sleep over it. I think if you're in the current recipient class, you're probably the most highly protected in this, and there's a lot of things that need to be cut and changed before someone comes after your specific check. I think there's a lot of issues of current spending in the government that are being focused on as opposed to necessarily cutting back, your Social Security. So that. And again, I don't have a crystal ball, but it's not something I would lose much sleep over. That being said, if you follow through all the discussions now and kind of the sentiment on, the concern over the debt and the deficit, and you work out all the numbers, eventually you inevitably get to the issue, you have to, of social spending in the United States and the fact that we are on a path that we can't continue. And so what it means is, to me, that if you're someone who's looking to getting Social Security payments 20 years from now, you're looking at a very different scenario. And I'm not in the camp that, well, you don't know if you're ever going to get it. I'm more in the camp that there's all sorts of little incremental things the government can do to change benefits to people in the future without taking them away, but reducing them or extending the time. Maybe instead of starting to withdraw at, I think 62 for most people is kind of when you can do it. There's exceptions under other circumstances, but you can start at 62 and, do you wait until 70, you get more. Those kind of things can change. Maybe it goes to 63 and then 64, 65, or maybe the cost of living adjustment gets changed so that it doesn't change as much with inflation. So that's the kind of thing that I think over time we may see a lot more focus on. And I could be wrong, but again, I wouldn't worry about the current benefits. It's just in the future, it's something I think it's going to have to be part of the national discussion. And the recession one, yes, anything could happen. Certainly there's a lot of movement right now, and things could trigger, anything could start us down a path towards recession. It could also become like a self-fulfilling thing. Like if the stock market sells off, then people feel like they can't spend as much. And so it can be like a feedback loop. That being said, to be honest, I thought we were in a recession 2 years ago. I was one of those that we're already in recession and we just don't see it in the numbers. And we actually just sailed through the last 2 years just fine. So, these things are always hard to tell. And again, it kind of goes back to why you want to have a portfolio that's really resilient and not dependent on one thing or another. And I encourage investors to think about recessions. I know they're difficult to go through, but as an opportunity, because when you go through a difficult period, it forces you to get more efficient. You can buy things at lower prices. It's a great time to put cash to work and so on. Where recessions are really tough is when you're an individual who's directly impacted. Like you lose your job and there's not a lot of other jobs available. But as an investor, if your portfolio gets hit, maybe think of it as an opportunity to reassess or rebuild that portfolio. And often some of the best investments are made during a time of recession.
Okay, great. Thank you. I think just one comment on that. My dad, who's 90, is much more aggressive than me. In the last downturn, he did his own research and he looked at everything that bounced back higher than before. So he switched those over to those and he did fantastic like five years later. So I'm always impressed by his attitude of investing. So we have 2 minutes. I would like to just ask Valerie and yourself if you have any last word to our audience and to our investors. So thank you so much for all of this valuable information. But is there any last piece of advice based on the question today or what we foresee in the future? We'd love to hear that from both of you.
Val, why don't I let you chime in first and I'll wrap it up. They've heard from me most of the time, so feel free to cover what you want.
Sure. No, the only thing I want to reiterate is just it depends on where you are in the market, what exposures you have, what your returns end up being. And so having a well-diversified portfolio really is kind of, unless you're in the situation where you have some extra money, you just sort of you're okay if you lose it and you want to kind of bet on these newer technologies or riskier places. But if you're, kind of saving for the long term and hoping to be able to use that to fund retirement or some other financial objective, having a good, diversified portfolio and not just thinking, oh, S&P 500 because it's in, 500 companies, you're all diversified. So because it really does, the span of returns any given year can be very different depending on the space you're in.
Thank you.
And I think we've covered most of it. The questions have been great. I just encourage people to, take a deep breath and look for opportunities. The way we try and handle all this is we have our buy list and our sell list. And we just wait for the markets to send us opportunities one way or the other. And we try not to be too reactive to, okay, there's news flow in the morning, some executive order or some tariff thing. We really do try and look for companies we want to own. And just the other thing to remember too is I know there's a lot of focus on whatever the latest and greatest and hottest thing is. But if these things truly work out, the good companies find a way to employ it. And so when we look for all the beneficiaries of AI, and it may actually surprise us. It could be something crazy. It could be something like, insurance companies that deal with mountains of paperwork and have offices full of people processing stuff that, like, all of a sudden is streamlined by really good AI technologies that can read through everything. We've already seen this in the legal field, for example, where some of the work that used to take hours and hours and hours has all been streamlined by software and has become much more efficient. So I wouldn't count out the good companies, even if they're not necessarily in the hottest spaces. So that would be my final thought.
Okay, great. Well, thank you so much, Terry and Valerie. Really appreciate each time we have this opportunity to hear and learn from you both. And thank you to DGP for always being a really great sponsor to the Non-Bay Homeowners Association. And I guess my last comment is, if you enjoy our webinars and you enjoy all of the activities that LBHOA puts on throughout the year and the years, please become a member. We are starting our membership drive again, and we are 100% volunteers. So, the membership fees is really what drives all our ability to put on all the great content that we do. So, once again, thank you so much to our speakers. We look forward to next time we can have an update, and again, all of this will be recorded, and we'll be sending the link to everyone who participated. So everyone have a great rest of the week ahead, and thank you very much.
Thank you, Jeff, and thank you all for the questions. Thanks.
Bye-bye, everyone.